Consider two bonds. Bond A, a one-year bond with an annual coupon of 3%, issued at par. Bond B, a two-year bond with an annual coupon of 3.5%, issued also at par. This means that for the same period, year 1, there are actually two interest rates being applied for discounting two separate cash flows, one at 3% and the other at 3.5%. But shouldn't there be only one interest rate for discounting? Well, if you're interested to find out how finance practitioners answer this question, which has everything to do with spot rates, by the way, do listen up as we try to answer this question for you. So, welcome back. Today we'll be focusing on yield curves, specifically how to compute spot rates given the par yield curve in a process known as bootstrapping. It's a key skill in fixed income analysis and for understanding our future topics on interest rate derivatives such as spots versus forwards, swaps, forward rate agreements, etc. If you're into CFA exam preparation or you're doing investment analysis, well, this video is for you. Let's get started. The par yield curve plots yields to maturity for bonds priced at par value, where coupon rate equals YTM. These are coupon-paying bonds like treasuries trading at face value across maturities. For example, a two-year par yield of 3.5% means a two-year bond issued at the par of 100 with an annual coupon of 3.5, and its yield to maturity is also 3.5%. Remember our previous lesson that if the bond has a coupon rate equal to the YTM, then it's issued at par value. In all of our examples a while ago, since they are issued at par, therefore the coupon rate is equal to the yield to maturity. Now, the par curves are market quoted and easier to observe than spot rates, which we will talk more about later. By the way, for our discussions here in our video, we will just focus on annual coupon bonds to make for less clutter, as the focus is really on the essential ideas and the big picture. You can always adjust to the actual realities of the bond market you are working on accordingly without any loss of generality. Now let's go back to the two bonds at the start, Bond A and Bond B, at 3 and 3.5% respectively. As we said, this means that for the same period, year 1, there are actually two interest rates being applied for discounting two separate cash flows, one at 3% and the other at 3.5%. So it turns out, yield to maturity does not really properly indicate what should be the proper discount rate for a cash flow occurring at a particular period. This is because YTM is really one rate applicable to all the cash flows of a particular bond. This means that yield to maturity is instrument specific rather than time specific. And it should sound strange to anyone why a discount rate for a cash flow would be dependent on the instrument rather than the timing of the cash flows. So the question still remains, which one do we use, 3% or 3.5% for the year 1 cash flow? Well, you might say, well, any of the two can be used. But if there are two rates that are in operation, there might be arbitrage opportunities. So there should only be one rate to preclude arbitrage. For example, if both 3% and 3.5% can be availed in the market, then a smart market player can borrow 1,000 at 3% and invest it at 3.5% both for 1 year. After 1 year, the proceeds of 1,035 will be redeemed and the debt of 1,030 paid off, leaving a profit of 5 with zero capital risk, meaning it's a pure arbitrage profit. Now, if markets are efficient and everybody tries to do this, the two rates should eventually collapse to just one rate, such that there are no more arbitrage opportunities available. So, here we're assuming perfect and rational markets, zero transaction costs, and all rates being available or investable. In this case, the rate that applies to the end-to-end cash flow should prevail. This is the spot rate, used to discount single cash flows at specific future dates. Let's imagine a 4-year bond with 4-year cash flows, each occurring at the end of each year, like so. we can strip these cash flows from the bond and treat each cash flow as if it were a zero coupon bond. By the way, we discussed zero coupon bonds before, and it's simply a single cash flow bond paid at maturity. So here, the 4 cash flows are treated as 4 zero coupon bonds. Therefore, each zero coupon bond will have an associated yield to maturity or YTM for each maturity. And since these are all single cash flow instruments, then each YTM of the zero coupon bond is actually the spot rate. Spot rates therefore are zero coupon yields, the true discount rates for single cash flows at specific times. They're derived from par yields via bootstrapping because coupon bonds embed multiple cash flows. Note that the first spot rate is also the par yield for the 1-year bond since there's only one cash flow. So this is a trivial exercise and the spot rate is also 3%. Bootstrapping. How do we actually compute for the rest of the spot rates? What exactly is bootstrapping? The idea here is that we should start from available information and work backwards from there. This means we need to work with the par yield curve, the yield curve that produces par value bonds. From there, we'll compute the spot yield through a recursive process, computing for each spot rate to compute for the next spot rate. It's like tying up your shoes, so you work with one shoelace at a time before you can work onto the next, or like strapping your boots one strap at a time until you do all of your straps methodically in the end. The idea is that the present value of all the future cash flows, when discounted at the appropriate spot rates, should arrive at the par value of the bond. So we work on one spot rate to compute for the mystery spot rate and use a dummy initial value for it, using it to compute the present value. Then we change the initial value and make the PV formula equal to par, here equal to 100. For our purposes, we shall use goal-seek in Excel and let the spreadsheet compute the present value of 100. Note that we need to use the 1-year spot rate and the 2-year spot rate, which is still unknown, so kindly check the formula provided here for guidance. We don't even need to provide an initial seed at this point, and what we call S2 here, it's simply left blank, but becomes the cell that Excel will change to compute for the present value. Excel finally computes the 2-year spot rate at 3.509%, which we promptly use to set the next equation and solve for S3, using the same process as before. Excel will arrive at 4.027%, and we set up our next equation to solve for S4 using all the previous computations to come up with this latest one. Finally, Excel arrives at an answer of 4.558%, and that is a trick. We now managed to compute the spot yield curve from the par yield curve by using the process of bootstrapping. We're showing the actual Excel screen capture over here to show the entire process as follows. Why bootstrap spot rates? Well, the spot rates give precise present values by discounting each cash flow at its maturity specific rate, unlike yield to maturity's single rate assumption depending on the maturity of the final cash flow of the instrument. This matters for, let's say, immunization, derivatives pricing, and fair bond valuation. In an upward sloping curve, spot rates lie above par yield since earlier cash flows are discounted less. Bootstrapping extracts these iteratively. Spot rates can be used for OAS or option adjusted spreads calculation, for swap pricing, or for mortgage-backed securities. Well, that's bootstrapping in action. Simple yet powerful. Like if this helped, subscribe for more fixed income stats and finance videos, and feel free to comment below to help support our channel. See you next time!